Okay, bro, welcome to the new video. Hello. Today we will analyze yet another monthly dividend stock according to this website called US News. But before we do that, bro, I want to tell you that stay tuned for tomorrow's video, which is going to be another self-improvement video about sleeping schedule, okay? And without further ado, let's scroll down on this website called US News. And let's see which stock we will analyze according to this website, because apparently all of those 7 stocks that we can see here are one of the best stocks for getting monthly dividends. And most of them are already analyzed on my YouTube channel. So today we are going to analyze this one, which is completely new, which is Ellington Financial Incorporated with the stock ticker EFC. And as always, bro, we will copy all of the most important data from all 3 financial statements, income statement, balance sheet and cash flow statement, into this Excel table. And here we will also analyze the most important bullet points from each of those financial statements for the last 10 years, because this will actually give us a better perspective of the company. We will see the development and we would be able to somehow decide whether we should buy or sell this stock. And all of this data could be found on this website called Macro Trends, and it's going to be linked in the description. So now, bro, without further ado, let's start with the analysis. And in today's video, I decided that we will do this a bit differently. First, I will present you all of the good things about this stock, and then we will cover all of the bad things. And finally, bro, we will decide whether we should buy or sell the stock. And without further ado, bro, let's go now to cover the good things. So the good thing is that total revenue and gross profit are growing through the all 10 years. As you can see here on the charts, for example, total revenue, amazing growth, gross profit, also amazing growth. So of course they are a buy. And now we come to the gross profit margin, which should preferably be higher than 40% in all of the years. And as you can see here, the gross profit margin is always significantly higher than 40%, which is absolutely remarkable ratio. And operating income is also growing rapidly, especially in the last year, as shown here in the graph. And that means that future income is actually going to be higher because of that. Because operating income actually means how much income will then through the years transform into the total revenue, okay? And now when we go to the balance sheet, you can see that the retained earnings are only disclosed in the last 5 years, and nonetheless they are growing massively. That means that the company has made more reinvestments back into itself instead of paying it as a dividends, because retained earnings are basically money that is reinvested back. And it's kind of similar to the capital expenditure in the cash flow statement, which shows how much money is the company actually investing into buying new land, buying new machinery, buying new equipment, and so on and so on. And here you can also see that the company, especially in the last year, is investing a lot of money back into itself. And speaking of cash flow statement, you can see that the P/E ratio is much lower than the competitors' P/E ratio, because here I stated the 8 P/E ratios from competitors and their average is around 20. And preferably, bro, we would want to buy stocks which have P/E ratio lower than 15. And this company has 13, which is lower than 15, and also the P/E from the competitors. So this is a great sign, because that might potentially hint that this company is kinda undervalued, because for each $1 profit, we should spend here $13. But if we would buy one of those competitor stocks, for example, on average, we should spend for the same dollar $19 or even 20, which is 7 more. So that's actually a slight sign that this company might be undervalued. And speaking of undervaluation, we come to the intrinsic value, which actually shows the fair price of the company based on calculations about cash flow. And here you can see that the intrinsic value for this company should be around $33. So basically this company is right now trading at a bit less than $12, which means that this company should be undervalued for $21 based on the intrinsic value calculation. So this kind of shows that the company is right now quite undervalued on the fair price, you know what I'm saying? And with that being said, we unfortunately have to cover also the bad things. And as you can see in the income statement, net income and net income margin are completely terrible because they are so unstable that we actually don't know what is happening, you know? Here you can see that in some years, in 2016 and 22, net income was even negative, which is absolutely horrible and completely bad sign, bro. And when we go to the the balance sheet, you can also see that they have a massive long-term debt, especially in the last 2 years. So in comparison to equity, bro, you can see that the debt is 800% higher than equity. And return on equity is also so, like, I don't know how to say, always lower than 10%, which is horrible. And additionally, it's also unstable as well, so we don't know exactly what is happening with this company. Obviously, in 2016 and 2022, they had negative net income, so this is why the return on equity is also lower, but otherwise it's so unstable and so unpredictable because of that. And as you can see, the debt to equity ratio that we mentioned earlier should be preferably below 50 or even at least 60%. But here, bro, 200, 300, 1000, bro, 800, absolutely horrible, bro, it's crazy. And now we come to the cash flow statement, and we can also see that the stock dividends are slowly decreasing through the years, which is a bad sign for us dividend investors, because when you are a dividend investor, you want to have dividend payments increasingly through the whole year. So this is also a bad sign, bro, unfortunately. And now we come to the final decision, and I think that you already guessed, bro, the final decision is not to buy this stock because they have a terrible amount of debt, bro. 800 or even 1000% is absolutely bonkers. This is way too much, bro. 110% is the top, absolutely top limit, bro. But not fucking 800, are you crazy, man? And net income is also, as you can see, completely unstable. We don't know what is going to happen next year because of all the data that is completely messy here. We want to see the growth through the all 10 years, just like total revenue and gross profit. Those are amazing charts, and operating income as well. But net income is completely trash, bro. I'm sorry to say it, but this is shit. And also dividend payments are decreasing through the years instead of increasing. And this company was supposed to be the top 7 best monthly dividend stock company. In my opinion, not, bro. The decreasing amount of dividends is a bad sign for dividend investing. So I would avoid buying this company for sure, bro. Don't even put it on your watch list. Right now, the company and the management are unfortunately a bit bad. But we will see what the future will bring, you know what I'm saying. So without further ado, bro, do the hard work and see you on top of the world.